when I realized I could buy a multi-million-dollar asset easier probably than I can my primary principal residence because it's non-recourse debt. As you guys know, it's guaranteed. It's not guaranteed. The bank secures it with the asset itself versus my personal balance sheet. And that was after looking at, I mentioned before, when I was looking at businesses, and that's one of the reasons I never pulled the triggers, because you always had to sign a personal note to guarantee the loan.
You're listening to the AZREIA Show. If you're looking for quality real estate investing information that you can trust, you've found it. Stay tuned and join the tens of thousands of members that have already benefited from AZREIA, your home for education, market information, support, and networking opportunities that will advance your real estate investing career.
Welcome, everyone, to another episode of the AZREIA Show. I am your host, Marcus Maloney, and we have our co-host, Mike Prete. How are you today, Mike?
Wonderful. Excited to be here.
And this podcast is all about helping investors and empowering investors one property at a time. And today we have Randy Langenderfer that's going to be joining us today. And we're going to be talking about multifamily and multifamily syndications. Randy is an investor with Invest Arch Properties based out of Houston, Texas. He's a syndicator of 1,500 doors as a general partner, as a GP, and he has several thousand doors as an LP investor. So he's coming with tons of experience and tons of knowledge as it pertains to multifamily. And the great thing about it is he transitioned from single family over to multifamily. So we're definitely going to talk about that. And we're going to talk about his transition from being a part-time investor to a full-time investor. So Randy, welcome to the show, man. How are you?
I'm doing great, Marcus. Mike, both of you, a pleasure for being here. And thanks so much for letting me join your podcast.
Thank you so much, man. It's a pleasure for you being here, Randy. So let's kind of take it back, right? Let's go back to the beginning. Before you had thousands and thousands and thousands of doors, who is Randy? What did he do prior to real estate?
I think that's a really good place to start just for your listening audience. So Randy Langenderfer, I'm based in Houston, Texas, as Marcus said, president of Invest Arch Properties. And I got started, my journey really started I was living in the Cleveland, Ohio market at the time, 10 plus years ago, when I really came to the realization I was working for a private equity firm and really concerned in the tail end of the Great Recession that I was going to lose a job. And I was an executive making a decent income and just really came to the kind of the aha moment that you need to find a different source of income, Randy, and quit putting all your eggs in one basket. And that started a journey of really trying to find, I looked at small businesses to buy. I looked at franchises. I was scouring everything and everything available to me to develop a second income while still working. And at that time, I had a brother-in-law who was a displaced exec for a large regional bank in the Cleveland, Ohio market, who I really love and respected, started flipping houses. He had gone to Armando Monteleglo's school in California and spent big money to learn Armando's process. Came back and said, you gotta join this with me. And I remember looking him in the eye and go, I'm a finance guy by trade, background, finance, CPA, MBA. And I'm going, you're stinking crazy. And then he told me I should use my IRA. And I said he was even more crazy.
Oh, wow.
Because as a finance person, you're generally risk adverse. And so anyhow, to make a long story short, I ended up proceeding with him and we started flipping houses, living in Cleveland, Ohio, flipping markets, flipping houses in Dade, Miami County, Florida.
Oh, wow. Okay.
And we had aligned with a group there that was actually doing the boots on the ground, finding the houses. We were the hard money lenders is the short answer. We were hard money lenders in this group. And so we had done several flips, 10 plus flips down there successfully. And about that time, as I indicated, my job opportunity was winding down working for a private equity company. And I knew I started looking for a job before I got displaced. and landed in Houston, Texas.
Wow.
Okay.
So real quick, so this was a big jump there. So one, when you're saying, hey, he brought the idea of fixing and flipping, Armando, HGTV, all this stuff that you see,
Yeah.
right? Crazy. In my head, then I was like, in Cleveland, that must have been another crazy, but you switched it and said Florida. So you never flipped a house, and all of a sudden you flipped 10 houses in Florida. So how did that work?
Well, as I said, my brother-in-law at the time, still my brother-in-law, I'm sorry, my brother-in-law had at Armando's school had partnered or made contact with this group out of South Florida, Dade County, that was flipping houses and needed money.
Oh, so
Okay.
Okay.
They had already been in business and had been flipping houses and needed money, very simply. And so neither one of us were the type of guys that are going to be pound swinging hammers, I'll say, if I can be honest. Not my gift. But we were happy to learn the process. And so we got really involved in, as you guys know, looking at the comps, looking at the markets, looking at the after repair market value, and studying this group. And we partnered with them on many of them. And like I said, that was the intro into it and got the fever and all the juices going.
Okay. So Randy, did you start with your IRA? Because you said your brother-in-law was like, man, you're freaking crazy. I'm not doing this. But it seems like he convinced you, or you was able to put some numbers to a spreadsheet and figured out, hey, you know what? This is not a bad idea.
I think you're absolutely right, Marcus. I'm that analytical guy. So it's about risk mitigation. So yeah, once I was able to get my head around the numbers and the process and how much we buying it for and studying all the comps and really spending a lot of time at it, actually traveling to South Florida to see some of the projects themselves, seeing the flips, seeing the markets, seeing the group, meeting the group. It was only after all that did I really decide to invest. And then, yes, I did start out using my IRA money, transferring it to a self-directed IRA from some of my previous employers, and never looked back.
Perfect. So what was your transition after you did those 10 plus deals down in South Florida? What was the next step? Because I'm trying to lay the foundation for our listeners.
That's a valid question. So when I was still doing that, as I said, that's when I relocated to Houston, Texas for what I'll call my day job.
Okay.
So I was still doing that. And when I came to Houston, I got really excited about, wow, from Cleveland, Ohio to the fourth largest metro in the US. I got real excited about the opportunity of being able to ramp up my business in Texas, of being a hard money lender, and came down here and on work, and I was living alone. My wife was, as we were transitioning, she was still in Cleveland. So I was here for about 6 months on my own. And I went to every real estate group you could imagine.
Okay.
Every REI group. I mean, I Googled them on the line, and there were like 13 different ones at that time, just in Houston, Texas. And I went to them all. I was just all in the process, and started attending those real estate groups. And that's when I did do some flips, some hard money lends here in Houston when I first came down. I started meeting people, networking, met a couple people that had been using hard money lenders and had a successful track record. And so key elements of my investment criteria. But then I basically attended a lifestyles conference here in Houston, Texas. Lifestyles is one of the large educational groups. Okay. And I attended their freebie sessions at first to start out with. And then I went to their paid session, their weekend session, where they did single family on Saturday and multifamily on Sunday. And it wasn't really until I attended a conference here in Houston on multifamily that I heard then Brad Sumrock, who's another big
I know Brad.
National education group, speak. And he really went into a lot deeper on the value proposition for multifamily versus single family. And that's when I remember he had 3 back-to-back sessions. And I went to the first one, and I ended up sitting in the second one just to repeat it because I'm a slow learner. And
absorb it, let it all soak in, right?
I mean, it was resonating with me. I'm sure you guys have had that feeling when you're, and it just resonates with you, and you say, I want to hear this. So it was just The first aha moment for me was when I realized I could buy a multi-million-dollar asset easier probably than I can my primary principal residence, because it's non-recourse debt.
Right.
As you guys know, it's guaranteed. It's not guaranteed. The bank secures it with the asset itself versus my personal balance sheet.
Right.
And that was after looking at, I mentioned before, when I was looking at businesses, and that's one of the reasons I never pulled the triggers, because you always had to sign a personal note guaranteeing the loan. So if the loan were to default, they could come after my house, my cars, my
you're on the hook.
other assets, and I was just not willing to do that. And I would encourage no one else to do that as well in your listening audience.
So you got into, so you basically, your brother-in-law gave you the real estate bug. You got that itch, right? And you started doing the hard money lending and the flipping and everything like that. Tell us about this first multifamily real estate deal. How did that transpire? Because you're used to just lending money on deals, not actually doing commercial deals.
That's another whole podcast in and of itself, but I'll give you the short version here, Timothy. So I was attending at the time the Sumrock group, and since then I've transitioned. I've been in Lifestyle, Sumrock, and now I'm in Rod Khalif's mastermind group and the coach. But at the time I was attending the Sumrock group, and I remember going to these networking sessions, and I say, how does somebody find a deal? Where do you find these deals? And they say, just hang around and talk to people. And so I probably attended for, I don't know, a couple sessions, and found the guy that the old adage, I know, liked, and trust. He was a similar guy, just for me, just left the corporate world and had found his first multifamily property. This was 2018 in lovely Beaumont, Texas. And so for anybody you're listening, Beaumont is about 110 miles due east of Houston on I-10. It's a very blue collar community of about 200,000, maybe 250, and very blue collar, heavily petrochemical related, with all the refineries along the coastline in Houston. I didn't know anything about Beaumont. I drove out there. I'm sorry, Beaumont, Texas. Yeah, this one was actually in Port Arthur. It's next to Beaumont.
Yeah.
Beaumont was my first general partnership. Port Arthur was my first limited partner. And the gentleman that I invested in this was a 225 unit property that was basically had been sitting vacant for several years. A developer bought it, refurbished it all, and was leasing it up. It was about 70% leased at the time. And so the play was really to acquire it, lease it up to 90%, refinance, take a bunch of money out, and live happily ever after. And so that's where the story gets really interesting. So after 18 months, we did refinance it. We got 60% of our money back as investors. And I'm this is 2018 again. I'm kind of pounding my chest thinking I'm a pretty smart guy. And then we followed by fraud, a flood, and a fire. And so the 3 F's, as I call them. So
right. We
found the property manager was committing fraud and increasing or overstating, I should say, tenant occupancy. And so the general partner, who I had known at the time and still know today, is a good friend. He fired the property managers, got some takeover and some stronger property management in there, only to be hit by Hurricane Harvey, which we were along the Gulf Coast and put 3 feet of water in all the first floor units. So everything had to be vacated, and you guys know that drill. You have insurance. We had insurance for it, thankfully, but that's a very lengthy process.
You had all of those displaced tenants.
All those displaced tenants and all those things to be dealt with.
So what did you, because I know that was a big step for you, right? Because
there's one more F.
There was a flood.
Slow down.
We recovered from the flood pretty much, and we redid all the units, started to release them up. And very regrettably, we had a fire in the property then. That was probably, I don't know, 2019, 2020, whatever.
Man.
And very regrettably, 3 young children died in the fire.
Oh, wow.
Here's another hard lesson for investors. The mother left 3 young children home alone, went out for the night. They died, and she sued us.
Wow. How did the fire start?
Don't recall. I don't know.
Yeah.
It wasn't her unit, but it took out, I think, 25 or 30 units of the 225. So it took out one building, which was terrible, but
So
the loss of
10%.
life is just devastating.
Yeah.
Wow.
And then only in
So-
America, she sued us.
Wow.
Yeah, that's on her negligence. So what was, and just out of curiosity, what was the basis of the lawsuit?
Somebody died. Somebody has to pay. I mean, very, very candidly, I don't mean to be insensitive, but
Mm-hmm.
that's really the basis of the lawsuit is somebody died, and so somebody has to pay.
Right.
And she
Right.
didn't have any money, so
So
Right.
I know, like I was saying, that was a big step for you, right? Because you're used to being a hard money lender where you're giving the money out to investors and seeing the product. Now it's you giving the money to a general partner saying, okay, I want to see my return. Did you learn during that what did you learn during that process of
man.
being a limited
I
partner?
mean, he could write a book on that building.
I
Yeah.
told her I got my honorary PhD in investing.
Yeah.
So yeah, you're right. On hard money, you're generally seeing your return in 6 months, maybe 9
Yep.
months, if it's a bad deal or a long deal. But yeah, so we waited 18 months to get a refinance. And so I guess I would say I felt comfortable with it only because I had studied enough. And that's another key takeaway for your listening audience is educate yourselves. That's how you mitigate any risk is to education and study it. And I really trusted the guy that was the general partner.
Mm-hmm.
He was and is a class act today. Fast forward, we got out of that deal after 6 years, just last year, and 4 years, I guess it is. We got all of our money back, but we didn't make anything in return.
Wow.
But this is the guy that put over $500,000 of his own money in the project to keep it afloat. And I don't know that he got all of his money back, but he put the limited partners first.
Mm-hmm.
So you don't know that going into a project, but as a limited partner, I will invest with this guy whenever he sends me something again, because
Oh, absolutely. Because he showed you that, the limited partners are first. If anybody's going to take a loss, me as the general partner, I'm going to take a loss and my investors are going to be made whole.
absolutely. And, that's the way it should be. So kudos to him.
Yeah.
Mm-hmm.
He's out there listening. I still respect him, like him. So
Yep. So how did you make the transition to become a GP yourself now? Because right, you went through that situation from 2016 or whatever to 2018. Now it's 2023. We went through, COVID, everything like that. How did you become confident and build a team to be a GP? Because it's not just having the money, but it's going out, finding the deals, making sure you got the right contractors, everything like that. So how did you do that?
yeah, I think I don't say everybody's career in real estate investing is a little different, but I would say I think mine is fairly straightforward, where I had invested in several limited partnerships before I ever invested as a GP, because and excuse me, I said I invested in 2018 in Port Arthur. It was 2014. We got out of it in 20. So in that time period, I had really continued to educate myself, networked, and just saw, I'll just be candid, the lucrative nature of being a general partner with the override percentage and stuff in there, that it's just very lucrative. It's a lot of work, but it's a whole lot less work than single family hard money lending, in my mind, where you're turning it over every 6 to 9 months.
6 to 9 months.
Scale there just takes a lot of effort. And when I did my first LP investment in Port Arthur, Texas in 2014, I did it again through my IRA. And I was such a chicken that I partnered with a buddy to form a trust. So each put in $25K, because I was really testing the waters just to make sure that this was a sound principle. So step-by-step answer to your question is step-by-step incremental improvement, and trying to understand, educate myself with mentoring, right? Mentoring and trying to network with people to lessen your risk along the way. along with your education. And it really, as you guys both know, it's finding somebody you just trust.
Right.
Just finding somebody you trust.
So that LP, I know you said that you put the money in a trust. Was it he put 25 and you put 25, or okay?
Yes, sir.
Okay, so you guys went in $50K on that first property in Port Arthur.
Port Arthur. And so we did that through, I mean, for those who are listening, I mean, that can be done through, there's a large self-directed IRA firm here in Houston called Quest Company. There's another one in Cleveland, Ohio called Equity Trust. There's a really big ones. And for your listening audience, that's an easier way to get into with less dollar commitment.
Okay.
You can also form a partnership. You could form an LLC if you wanted to do it.
Okay. Now tell us about your being a GP, right? How did you find that deal? Was it through, well, naturally, I'm believing it was through brokers, but building those broker relationships. But how did you build your team to where you had the confidence to go out and be a GP?
So between 2014, I became a GP first in 2018. That's where I confused the dates. I don't know how many I invested in, but I had invested in several. And a couple of them sold quickly and were extremely profitable, furthering the I'll call it the desire for more. And I found that first one really just old-fashioned networking, conferences, meetups, and ended up finding a group of guys that were also, they actually had identified this deal. This first deal that I was a GP on was in Beaumont, Texas. First LP was in Port Arthur. That's why I confused those two. The first GP deal was in Beaumont, Texas, that I described. And this was 2000, and I think it was is when we did the first Beaumont deal. So the way you find those deals is just old-fashioned networking. And it becomes, what do you have to offer the group? Maybe you're an underwriter. Maybe you're a marketing person. Maybe you got a large balance sheet that you can KP or do something on. But it really just becomes, what do you have to offer the group? And through those large educational groups, you're going to get contacts of SEC attorneys and brokers and property management companies, et cetera, that you can leverage as well in your growth. Today, though, in 2023, so much of that stuff is available through podcasts like yours and meetups that investors can go to and really leverage those as well at very low cost.
So we talked a lot about LP, GP. When it comes as an LP, like when you're looking to invest in other projects, what are some due diligence processes you go through to understand if this is a fund that you want to invest in?
It's a great question, Mike. As I put on my LP hat, and I still do this today, as assets turn over, I will invest limitedly as forever. I just am convinced on the asset class. But I talk about this, other things too. I think all limited partners should develop their own investment strategy. And I encourage my students and stuff to actually write it down so you don't get distracted, especially when you're starting, because it's so easy to get diverted with what I call the shiny object syndrome. I'm sure you guys have heard of it, where you get an email that says 25% IRR or 5x equity multiplier in 6 months or whatever, something like that.
Right.
But it's so easy to get diverted. And if you don't, when you're starting out, I said, I coach people to put it on what markets you're looking at and the kind of investments you'd be willing to take. So, and this is what I've refined over the years. When I started out, it was simply, I knew the guy very well and I trusted his judgment. I had reviewed some of the underwriting, but so it's education, developing that strategy, and again, write it down. What kind of markets are you looking at? So today, when I'm focused on the Sunbelt areas, like a lot of people across the U.S. So if somebody sends me a property in Wichita, Kansas, I don't care if it's got a 50% IRR. I'm not going to look at it today. Or if I get an email, I mean, the other one is as somebody that my investment criteria, I really have to know the sponsorship group and their track record. So again, you get that email from somebody in Wichita, Kansas, that sounds great, but I don't know the market and I don't know the group. Those are two big strikes for me. I simply won't invest. Maybe I know the group, the sponsorship group, but I don't know the market. I may look at it for a little bit,
Right.
but I guess the first criteria is I look for markets I understand, sponsorship groups I trust and like, and have a proven track record, that I'm aware of. And then it's like I said, I've been a GP recently in Tucson. So I was asked to join a group to invest there as a general partner. And I don't know about everybody, but I get on a plane and I go to Tucson. I look at all the comps and I travel the market and meet the property management company and some brokers while you're in town and try to get a grasp of the local submarket itself. I did that when I was even an LP investor at first. I don't do it a lot anymore because I've got a group of sponsors that I'm worked with a lot and I trust
that you work with. Mm-hmm.
As an LP, I would say develop your strategy, and I would put in there the submarket, the sponsorship groups, knowing them, and what types of returns you're looking for. I ask that people all the time. I was just going to say some people want yield. Did you know?
Yeah.
And other people are looking for the large kicker at the end when it sells.
So speaking of those people looking for those returns, what are some tips maybe you can provide for our listeners? Because you need money to do deals, right? So any raising capital tips that you can share?
I was going to give you a smart aleck answer, but I won't.
Go for it. We love it.
Raising capital is one I've really focused on in the last couple of years of really trying to, and I first thought I'm a corporate guy. I work behind the scenes. I'm a numbers guy. Man, asking people for money just isn't my gig. But when I got my head out of my rear on that and said, you can do this, and started just doing it, it's about developing a brand. It's about developing opportunities, developing a little bit of history. And then so today I'm out there, fast forwarding today on capital raising. I'm on not all the social media, LinkedIn and Facebook primarily. I'm posting several times a week. I like to appear on podcasts to further my brand. Speaking engagements wherever I can find them. So the funnel at the top is many of those, as well as partnering with other people. But at the end of the day, to be a capital raiser, you have to have success, right? I think.
Mm-hmm. Okay,
Nobody's
right. Got to have that track record.
You got to have that track record. And that's getting more and more difficult, as we all know in our markets today.
Mm-hmm. So speaking of some of the difficulties in the market, Randy, what are you seeing up on the horizon, right? We're seeing everything on CNBC. We're seeing everything on Fox Business News about commercial real estate. And a lot of it is geared towards office space. But yet, large multifamily is starting to kind of get sucked into that loop of, hey, we have mortgage interest rates that's about to reset and adjust. We have large multifamily investors that's turning over keys to the banks. They're doing more capital calls. Kind of what are you seeing on the horizon in the industry?
If I had the answers to all those questions, I'd be on the talking circuit making a lot of money. But I think one guy's opinion is, you hit it all right in the head, but I think anybody that did a deal, and I've done a couple of them in 2020, 21, or 22, you had to do variable rate debt at the time. And a lot of it is just timing in the market cycle. I'm in a lot of deals that are prior to that, some in that time period. And that period, 20, 21, and 22, is just all going to be laden with variable debt that's coming due for either a rate cap renewal and an extension of the bridge loan, or trying to find refinancing opportunities or sale opportunities. So there's going to be some bloodletting in the industry. And regrettably, there are deals that are going to go south. I don't know any longer that it's a blemish on somebody's record if they have one, because it goes bad, because I can name a couple operators here in Houston that are great operators. I've had to turn the keys over to the bank recently just because the debt was overwhelming, and it's very difficult to make capital calls these days. You got to have a very articulate vision of how investors are going to get their money back, and have that human capital build up where they trust you, that you can perform on it. So very difficult to make capital calls. I have not had to make one yet. But will have to next year, just because of the rate cap renewal. But everything I'm told is, if you want to raise a buck, think you're going to only probably get 40, 50% of that dollar. and it's going to take you a lot longer to get it. So I don't think that the market has a way of cleansing itself and weeding out some bad operators, but I think that's also going to be opportunities for the future.
Mm-hmm.
Right.
Areas where there's going to be properties coming online that are A-, B+ that you never thought you could get if you got the right relationships with brokers. So with every downturn, there's a opportunity as well that investors need to look at. So this is the time when your passive investors should be cultivating relationships with general partners and understanding what their view of, because everybody's view is going to be a little bit different.
Yeah.
Okay. Key. Very key. So Randy, kind of wrapping up here, man, how can we, if somebody's looking to invest and they want to say, hey, you know what, let me do my due diligence about Randy before I, make a call or look into working with him, where can we go to find you? Where can we go to follow you? I know, say, Facebook and LinkedIn. Give us your URLs.
It's Randy Langenderfer, Langenderfer, and I'm sure we'll put that in the show notes, those links for Facebook and LinkedIn. Also, my website, www.invest, invest-ark.com. It's got a contact me page on there. I'd love to chat with anybody if they have an interest about anything real estate wise. And those are the easiest ways. And, I just really appreciate you guys having me this afternoon.
Yeah. Thank you for being here.
Yeah. Thank you for being here, Randy. You brought a lot of insight to what's going on in the market as far as commercial real estate. So you guys know exactly what to do. Our listeners here along the Western Seaboard and across the nation, feel free to reach out to Randy, get additional information from Randy in regards to commercial investing. And please let me and Mike know how we're doing on the podcast by giving us a rating or a review. And then all of the detailed information is down in the show notes. And feel free to become a part of the family, or feel free to come as a guest and see who we are and get affiliated with us. So thank you so much for being wonderful listeners and a wonderful audience. And thank you, Randy, so much for being a great guest, man.
Well, it's my pleasure. Next time I'm in Phoenix, I'm going to try to get to your meetup. So
yep, give us a call.
One day I may show up there.
Yeah, definitely, because we have a branch down in Tucson too. So if you need additional information about the Tucson market, that'll be a great time for you to look us up and see what we can do for you.
Look forward to it, guys. Thanks so much.
All right. Thank you. Have a good one.
Thanks for listening to the AZREIA Show with your hosts, Marcus Maloney and Mike Prete. We hope you enjoyed this episode. If you found this information valuable, head over to AZREIA.org and learn more about our community.